Well, guess what? The IRS is back with some more tax changes that they're going to bring in 2024. Now, it's important to note that these are just the proposed changes, right? The White House just produced their 2024 budget, and these are the changes that they're proposing. And when we really look at these, it really starts to get a little, it starts to hit me in the gut a little bit, because as small business owners, all we really care about is being able to provide a great quality service and being able to keep majority of the money that we're earning, right? And a lot of times there's benefits to being small business owners because, we get a lot of other tax incentives because we're providing a service that the government wants us to provide. But when we start to see some of the changes that they're proposing, we realize that they're really starting to try to tax our dollar in as many ways as possible, it really starts to kind of get under my skin. And I understand the concept. Let's not get it twisted. I understand that the government needs taxes in order to facilitate infrastructure. But before we really get into all of that political and conspiracy and all this other stuff about what they do with our money, let's just focus in on what they're proposing and how that's going to impact us as small business owners. All right, so let's take a look at a few of these. First off, I want to give a shout out to National Federation of Independent Business. If you guys have never heard of the NFIB, they're constantly producing just several reports, and they have different programs and all this good stuff for independent business owners. So if you guys haven't checked them out before, go ahead and check them out. But this information specifically, I got directly from their website. So what I'm going to do here is I'm going to break down kind of where we are today, what they're proposing to be changed. Then we're going to talk about how does that actually impact us and what do they expect by that impact too? Like, what do they expect as far as dollars in their pocket? So the first one we're going to start off with is the corporate tax rate. Now, the corporate tax rate, right, is saying, hey, our business is filing as a corporation. Any of the income generated on this by this corporation is going to be taxed at 21%. That's the corporate tax rate. And that's where we're at currently. Well, next year, they want to try to increase it to 28%. Now, at the end of the day, guys, the way taxes work, if we are really generating a ton of income that's being passed through to us, our tax bracket as of right now goes all the way up to 37%, and then it kind of tapers off. So even if we were able to pass a lot of that income through the corporation and get it taxed at 28% instead of our 37%, you can still see that there's quite some saving. But by jumping up 9% from 21% where we are now to 28%, what they're expecting to get from this is $1.3 trillion. That's coming from us. That's coming from the business owners, the taxpayers. We will be paying an additional $1.3 trillion across the states just by increasing it by 9%. Now, although that's a punch to the gut for sure, we're just now really getting started with what they're proposing. So the next thing that they want to propose is currently there's an investment income tax rate of about 3.8%. They want to be able to expand this tax rate to all business income, small business income, over $400,000, and they want to increase that from 3.8 to 5%. So just between those two changes, they're looking to get another $650 billion from the taxpayers, from us, the small business owners. And that may not seem like a ton, but corporate tax rate jumping, small business income tax rates jumping, adding on additional taxes or expanding them to the different categories or the different amounts of income that we can bring in, all of these things add up over time. Now, this next one really starts to get me here because we just talked about corporate tax rate going from currently 21 to potentially 28, right? And we talked about how if our individual income bracket was 37, well, then we might have some savings in between there still. Well, currently what it says is the top individual rate is 37% for any income over $578,125 if you're single. All right, so if you're a single guy, you're making income over $578,000, you're going to be taxed at 37% on anything above that. And then it says it's $693,750 if it's joint, right? So if it's a married couple making more than that, that's the absolute highest tax bracket that you can receive. You can't be taxed any more than 37% on the dollars earned above that. But check this out. What they're considering doing is increasing the top return, all right, the top charge, the top tax bracket from 37% to 39%. Now, it may not sound like a lot, but that 2% on those high numbers, they start to add up. And here's the thing though, the threshold of the amount that they earn, they want to drop it. So we just talked about for a single person, 578,125. That means at 578,126 and anything above, it's 37%. But they want to drop that down to $400,000. So instead, they took away $178,000 that you could be taxed at the next lowest bracket. You would have been taxed at 35% instead of 37. Well, now they're saying, hey, look, earn some money less, right? Earn less money. Earn $178,000 less, and then anything you earn above that, we're going to tax at 39. For anybody making over this 578, close to $1 million, this is going to be a big hit, right? So basically, for that 178,000, from 400,000 to 578, where it was at 35%, now it's at 39%. So that's 4% interest, or I'm sorry, that's 4% of a tax rate that you're going to pay on that additional 178, plus the 2% more, 37 to 39, on everything above that. They brought it down. And then for the joint, they're saying 450 jointly. 450. If we look at 578 as a single individual to 693 filed jointly, what they're basically saying is, hey, look, we'll give you another $120,000, give or take, right? Maybe closer to 118. I'm just doing quick math here. $120,000 you guys can earn as a couple, and then we'll move you to the next tax bracket. Well, here at 450,000 joint, they're only saying, hey, as a couple, you guys can make $50,000 more, and then we're going to increase your tax rate. Does that make sense? Now, here's the thing that they're saying about this, guys. The reason they want to implement these is because they're making claims that small business owners like you and me are using this to avoid taxes. Like it's a loophole. It's not a loophole. You're the guys that wrote it. You wrote the tax code. We're just following what you wrote. It's not a loophole at all. But now they're seeing all the money that they're missing out on, and they want to start changing things. So with this change alone, they're expecting to capture another $235 billion in taxes that they can collect just from that small change. So now we got a few more to cover, and it only gets more intense from here. And the reason I say it gets more intense because I get more intense about it because it just rubs me the wrong way. The next one is capital gains tax. Now, for those who don't know, we have capital gains tax, meaning when we buy something at a certain price and we sell it for a higher price, that's called a capital gains, and we're gonna have to pay a different type of tax on that. Now you have short-term capital gains, which is basically I buy it and sell it in less than a year. And then you have long-term capital gains, which is saying, hey, I bought it, I held it for 2 years or a year and a day, and then I sold it, and then boom, now it's a long-term capital gain. Well, right now the top capital gains rate is currently 23.8%. So that's saying the absolute most you can be taxed on capital gains is 23.8%. Therefore, if you made $100,000 and you were charged the full thing, you would pay $23,800. This is what they're proposing to do, guys. They want to nearly double capital gains rate to 44.6%. 44.6%. Now, here's a little caveat. It's going to be for income that's over $1 million. All right, so it's not like, hey, we're out there, let's say we're flipping a house, we're doing whatever, and we're making 200, 300,000. I'm curious to see what the actual tax bracket scale is going to be when it comes to capital gains. But hey, if you build a business and try to sell it and you get capital gains on it, they're going to take half. They're going to take half of your money, 44.6%. So this is something that is going to be extremely relevant think about all of the boomers right now, who in the next 3 to 5 years, they intend to sell off assets, sell off companies, sell off whatever in order to fund their retirement. Where they may have been expecting, hey, I can sell this, I can move this money, and then I'm gonna get this large nest egg. They planned it out perfectly and they know, hey, I got 10 million, 5 million, I can put it into a small investment fund, collect the dividends and live off of that. Well, now if it was 10 million, it potentially can be cut in half. If it was 5 million, it can potentially be cut in half. And we all know once you start to cut in half proceeds, our return on investment drastically changes. This is another big one that was pretty frustrating to hear, We'll see if it passes, but if they do, for anybody who has aspirations of selling things or growing your business or selling things bigger than $1 million, and having capital gains of over $1 million, this can be something that can really, really come back and bite us. Now, just with this alone, they're expecting another $214 billion to be generated from this, and as far as tax collections goes. Now, while we're on the topic of capital gains, they're also looking at removing the step-up basis. All right, so this is how it generally works with step-up basis. You guys may have heard the term, hey, when I die and I leave it to my whoever, my predecessor, my heir, when they receive the property or the asset, they get a step up in basis. And so here's what it means. Hey, look, I bought a property for $50,000 today. That's my cost basis. Let's say I hold that bad boy all the way until I pass away. All right. Well, when I give this to my heir, to my whoever, my predecessor, the property might be worth like $500,000. Right? Let's call it $500,000. So if they accepted my cost basis at $50,000, and then they got the market value of $500,000, well, whatever they do, they're going to be responsible for that capital gains in between, that $450,000. So with the step up basis, what they said was, and this is how it's been for quite some time. All right, I got this property for $50,000. Today, 30 years later, it's worth $500,000, and now I'm going to give it to my heir. Well, when I pass and my heir collects it, they're actually going to step up the basis to today's market value, right? So he gets it at $500,000. The basis goes up to $500,000. So therefore, he doesn't have any capital gains, which is fair, because if you are gifted a property, why should you be responsible for the $500,000 in equity that came from 30 years ago, right? This is a very strategic tax law that we've all been abiding by. And this is something that has been very popular in estate planning, right? And passing down generational wealth. All of the greats have done it before, and many small business owners have been able to do this to really create that legacy. But now what they're saying is, hey, look, we're going to repeal all of that. Take the full step up basis away. And so now when people inherit this property from their father or their grandfather who bought it 30, 40 years ago, people who inherit this company that's been in their family for 20, 30 years, they're going to look at the cost basis that the original founder was able to get it at and then pass it on to the other individuals. So now when we try to do this and set up our family, right? We want to set up our family. We want to say, all right, look, I've had this property, or I have this company. The company's now worth $1 million. I want to give it to you. Even if you sell it, you're going to pay very little on capital gains. You get to keep most of that $1 million. Right. Now what we're saying is, hey, take that full thing away. Now you have to pay capital gains on that full $1 million. And guess what? Just like we talked about before, they want to increase that capital gains tax bracket to 44.6%. So now for us trying to plan our legacy and try to plan for our children, plan whoever it is that's going to be accepting our assets or our properties or our companies, half of the capital gains, half of the value can be wiped away as of next year. Very painful. Now with that one alone, they're thinking another $214 billion that they're expecting to be able to collect from taxpayers by collecting that 44% or some variation in between a 44 and the current 23.8. All right, now let's get to the last one here. Now, many of you may be aware that Congress actually allocated another $80 billion to the IRS this year, or earlier this year, in order to really bolster up their enforcement section, right? So when they can go out there, they can review many more tax returns, do audits, and try to catch anybody who's finding tax loopholes or doing tax evasion, with the expectation that they would be able to find money and then recoup the money. Right? That's been a thing that's popped out. Now with this new proposed White House budget, again, what they're thinking about doing is budgeting an additional $29.1 billion, another $30 billion to further increase the enforcement activities of the IRS. Now, here's kind of the part about this that, kind of rubs me the wrong way. One, how they intend to use the $80 billion has still not been fully identified or disclosed or laid out in a plan. And if it has, I haven't seen it. Many other people haven't seen it. So if you've seen it, please let me know in the comments, point me in the right direction. But essentially 80 billion from taxpayers are being used to attack taxpayers. Now let me be very clear. You know I am not a proponent for avoiding taxes or cheating the tax system or anything of that nature. I am very big on we do exactly what we're allowed to do, but that's why we study the tax code so we know what we're allowed to do and we take full opportunities as they're presented. But now what's happening is $80 billion is going out to enforce, further looking into us. And again, I'm only talking about the good acting, ethical business owners out there who are just doing their best to try to make impact in the world and receive profits to be able to take care of their family. They're already doing that to us. Now they're saying this 80 billion is going to be used up, and this additional, let's call it $30 billion, is going to help increase enforcement activities in 2032 and 2033. Now that's a little bit further away, but they're saying that that 80 billion is going to be used up between now and 2032. And they already have a plan for another 29 billion, 30 billion to go into the pockets of those enforcement arm of the IRS to come back at us again. Just within that aspect, they're looking at about $134 billion that they can collect. In total, with all of these changes, they're expecting to cost the taxpayers, that's us, and put in their pocket $2.5 trillion. $2.5 trillion. It's going to cost us, the everyday business owner who's waking up, doing what we have to do, providing a valuable service for our clients, collecting our money, doing everything properly, and trying to support our family. Now, again, I get it. There might be some bad apples out there. There might be some people avoiding taxes. Absolutely. We need to, make sure that everybody's hearing that. I'm not denying that. I'm not arguing against that. But it's very difficult for me to sit back and see how the money is being spent, how much debt we've accumulated, right? How much money is going outside of the country when there's apparent problems inside the country. And believe me, I served. I understand that a lot of these moves are strategic, but sometimes they're obviously strategic and it's like, okay, this makes sense. And a lot of times they're just like, what is going on? What's happening is the money is going out and they're turning inwards to us, the taxpayers, in order to try to collect the deficit. That's the part that upsets me the most. Now, again, I'm not going to get on here and really talk about the political views. I don't do debates on political, whatever the case is. I'm just sharing with you why it upsets me to see this. So how do we, as business owners, take all this into effect? Again, it may not even happen. It may not even happen, but how do we take all of this into effect and how do we prepare for it? Well, the biggest thing is we have to stay on top of what's actually coming. We have to know what they're changing and we have to live inside of that IRS code so we can see, all right, although this has changed, what else has maybe been added for us to take some additional benefit. For example, guys, when Trump was doing his debate against Hillary in whatever year, he openly said that, yeah, Hillary takes these certain tax loopholes. Donald Trump said he took the loopholes, all these other things. He specifically stated what we all know inside the small business realm is that these were designed by the IRS and by the Congress and by the powers that be to collect taxes, but also to incentivize certain things. So we know that as business owners, we're still going to be incentivized. The business owners that are really going to be hit and impacted are the ones who don't do the research on how to navigate these problem sets and just let them hit them in the face and say, you know what, now I got to pay 44% on my capital gains. Now, I don't have any more step-up bases. My son, my daughter, my children, my charity, whatever, they're going to have to pay another X amount percent or 50% on those capital gains, right? So that's just my piece to it. But as we stay forward thinking, as we always want to lean forward and understand this, I highly encourage you, I empower you guys to go out, make sure that you look at the National Federation of Independent Business Owners and the Small Business Administration. That's another great online resource. Both of them are backed by the government. Well, not backed by the government, but they're essentially government entities or national entities is what I mean. So they're going to have a ton of resources, articles, publications that can help you get educated. And as always, you can always come back to this channel, guys. If you enjoy content like this, please let me know. I love to share this type of stuff with you. I want all of us to, be on the same page and understand what's coming our way so we can stick together and figure out how to navigate this. All right. As always, thank you all for watching, and we'll see you in the next video.